discussions with Eskom in terms of making sure that they understand what it is that they are supposed to incorporate in the file. And also Eskom themselves have issued various internal memos and documents to their own staff members, articulating the rules, that these are the rules of the pension fund, this is how you exit a pension fund. So we are very comfortable as a fund that Eskom knows the rules, they know how the rules should be applied, and we rely on them to make sure that the rules are applied, because they've got the source documentation which we as a fund unfortunately do not have. So I think I've taken you through as well the process that we onboard a new member in terms of the various files and the various forms that we then rely on. And also when we exit a member as well, we also do the same, where we place reliance on Eskom to make sure that the information that Eskom provides is actually correct and accurate for the reason that the member is exiting the fund. In terms of the forms that the fund has that are applicable, the forms have got various rules that you have to tick, that this is the reason why the member is exiting. Also, the member has to sign on a particular form to confirm that that is correct, as well as Eskom as the employer. When we get an exit form, they have to sign that this form has been reviewed and is correct, and the applicable rule has been applied. And this has been consistent with what has happened in the past. I think there was a question as well, or a comment that came around what are the available rules that can exit a member. There is various rules that a member can exit through. We've got Rule 18, Rule 23, Rule 24, Rule 25, and Rule 28. Those are various forms under which a member can be exited from the fund. As part of our submission, we have included the fund rules. So if reference is required, we can then go to the fund rules and make reference in terms of what each of those rules entail. I just want to focus a little bit on one particular rule out of the rules that I've mentioned. And again, I just want to explain the principle around the rule. When we again get to the Molefe specific circumstance, we will then come back to the rule, but at least you will then have context. I want to focus on Rule 28. Rule 28, before Rule 28, there's a heading in the rules that says retrenchment. I think this issue was much subject of media attention, that Rule 28 had been utilized, but the heading says retrenchment. If the heading does say retrenchment, but if you look at the rules itself and the substance of the rule, really this is a rule that deals with the retirement of a member who has not reached the age of 65. It then has got certain conditions that need to be satisfied for this rule to be applied. It says that a member who has not reached the age of 65 can be retired from service owing to a reduction in or reorganization of staff, or to the abolition of his office or post, or in order to facilitate improvements in efficiency or organization, or to retrenchment generally. I think we need to just note that because we will come back to that rule when we deal with the issue of Mr. Molefe. Then the rule has got subsections. It's got subsection 1 up to 4. When we deal with the Molefe issue, we will focus on the rule itself, and we will focus more closely on subsection 3. Subsection 3 of the rule deals with the issue of a member who has attained the age of 50. Again, we will then come back to that. It also goes on to say a member who's attained the age of 50, or who had attained the age of 45 years, and who is listed. There's a particular appendix that was attached to the rules, and has not less than 10 years pensionable service, becomes entitled to a benefit in terms of this rule. I think it's important that we just note that rule, because again, when we deal with the Molefe issue, we will come back to that rule. So that is generally how the fund itself operates, and that is the issue. I think still on Rule 28, there is the issue that when you read Rule 28, it goes on further to talk about the issue of the discretion that needs to be applied by the employer, that at the discretion of the board. Again, we will cover that issue in more detail when we get to the Molefe issue. So there's also another rule that I want to touch on, which again I'll come back to later. This is Rule 21.4. Rule 21.4 specifically deals with the ability of the employer to be able to purchase additional service for an employee. I think we need to just note that rule again, and note that it's not unusual for an employer, especially in a defined benefit fund, to be permitted to purchase additional service, because again, this will become relevant when we deal with the issue of Molefe. And again, maybe for purposes of record, that rule reads that an employer may make a special payment to the fund in order to add to the pensionable service of a member in his employ such period of past service as the board, after consulting the actuary, determine. So I think it's also important just to deal with that. It's important also to note that over the years, Eskom has applied these rules, to a number of its employees. It has purchased additional service for other employees before, and it has retired other employees using Rule 28, which will be the subject of the discussion. I also want to highlight that the fund has got regular interactions with the employees as well. As a fund, we have a responsibility that we need to engage with our employees, inform them especially those that are new to the fund. Even those that are not new to the fund, you find that issues of pension fund are issues that they are not dealing with on a day-to-day. And some issues around the pension fund are complex issues, so we do engage with our members on a regular basis. When it comes to executive Eskom employees, what we do, we actually go a step further, where we can even have what we call a more personal and intimate service to those members, where we go and sit with them on a one-on-one. Given the number of Eskom employees, it will be difficult to do that for all 46,000 employees. So we would generally make presentations on a wider audience. Some of the presentations are initiated by the fund, but we do have instances where a small group of members call the fund and say, we are sitting somewhere in Cape Town, we would like the fund to come and address us because there is this issue that we do not understand. And then the fund, as part of its member communication initiatives, does accede to those requests. I hope that gives a good indication in terms of the background of the fund, in terms of how the fund operates, and also I've drawn attention to some of the rules that would rules of focus as we move forward. I would like now to move specifically to the issue of Mr. Molefe.
Just before you get there, can you just take the committee through the different forms of exiting the fund, your fund?
Okay. In order to exit the fund, you can exit the fund in various ways. You can resign from the employer, whereby you then choose that you want to take your benefit. You can either transfer it to another fund or a preservation fund, or you can withdraw it and take it as cash. That is one form of withdrawal. If you want to take it as cash, or if you want to withdraw it, we do a calculation where we compare what is called an MIR, Member Individual Reserve, and that will tell us whether your investment, using actuarial factors, what's the value of that investment vis-a-vis your contributions plus interest up to that point. Then the higher of the two amounts is what you would then take out. You can die, be deceased, to exit the fund as an active member. If you die, there's again a rule that deals with debts. In terms of the Act, there is also what is called Section 37C, where then the board has to then allocate your benefit. We calculate the benefit based on twice your pensionable salary, and that gets distributed to your beneficiaries. We then also calculate a spousal pension that we then pay to your spouse. If you have children that are under the age of 21, then there is also a pension for those children up till they get to age 21. You can retire normally from the fund. You either, if you are 50 years, we can use Rule 28. The employer has to agree to that. It's initiated by the employer, not the fund. Or if you are age 55, you can retire on your own. You don't need permission from your employer, but there would be penalties that will be applicable, which will then reduce your benefit. Or you can get to age 63. When you get to age 63, the penalties are no longer applicable. You can retire. Then the forced retirement age is age 65. So once you get to 65, you then have to retire from the fund. You cannot continue being an active contributing member. There is also ill health benefit. Generally, other funds insure ill health outside. Given the size of the fund, we are self-insured for ill health benefit. So if you are unfit for duty, there's a process that we go through where you are assessed medically and then you are medically boarded. The fund has got a benefit which we call an ill health benefit that you will then be entitled to, which will exit you from the fund. So those are the means and forms of exiting the fund.
We can then get to where you wanted to get us.
Okay. I'll start with at the inception, when Mr. Molefe was appointed at Eskom. I think it is common knowledge that Mr. Molefe had worked at Transnet before he then went to Eskom and acted at Eskom for a number of months, and then was appointed to Eskom as the group chief executive of Eskom. So according to our records as the fund, we have Mr. Molefe having joined the fund on the 14th of September 2015. I think I'm mentioning that date because you will note that as we move along, there are some discrepancies in terms of the dates. We had never had sight of his employment contract, but later on, when there were court cases that were ongoing, it's only then that we had sight of his employment contract. I will come back to the court case and how it affects the fund. At that point, I think we then realized that actually the effective employment date that was cited on the employment contract was 1 October, which is different from the 14th October. When Mr. Molefe exited the fund, he signed his forms and recorded his exit date as 25 September. So there's 3 dates now in terms of when his, he cited his employment date as 25 September. So the fund, according to its record, I think I explained earlier on that the fund receives information from Eskom. It received the leg file, which contained information, and in that leg file, it highlighted 14 September. We then received contributions for September. So we then tied that date to the contributions that we received. When he exited, when he signed his form, he said his employment date was 25 September. His contract cited 1 October. Maybe let me deal with the issue of exiting him, then I'll come back and tell a chronological story, because when we exited him, we had to now decide which date. At the time, we had two dates. We didn't know about the 1 October. We knew 14 September and 25 September. Given that the fund had received money dating back to 14 September, we then used that as our date of his employment or his membership to the fund. Looking at the difference between 14 September and 25 September, from a financial point of view, given that we had received payment for those days, it was negligible and nothing turned out of that for the fund, so the fund utilized the first date. So I think this is just the first issue, because as in the documentation that we've submitted, these dates do come up, so I think it's important that we just deal with them upfront, that there was this variance. So again, when Mr. Molefe was then became a member of the fund, we received a leg file. I've explained in terms of the information on the leg file, and one important thing that was on the leg file, which is the file that contains membership data, was a code. This code says PPX, and in our agreement with the ESCOM, according to us, PPX means that you are permanent and you are an executive at an F-band level at ESCOM. So when when he first came in September and we did our recons, we checked that to say, is he permanent? He's on permanent, fixed term, he's an executive. So we can tick the box to say that we've satisfied ourselves that what ESCOM is giving us, they are confirming that this member is an eligible member, because the issue of permanent and non-permanency talks to eligibility. So that was done. And then Molefe became a member of the fund and contributed on a monthly basis from there on. I think the first month there was a bit of a delay in terms of his contribution, and because we had received the leg file, but his name was not on, I think, the pay file. We then inquired to say, there's a discrepancy here. They then, I think, processed immediately payment for their contribution for that month, and then going forward, they then added his name in the normal pay file that we received. And we continued to receive contributions from Mr. Molefe from that point on until the point that he exited as a member. What happened just before he was onboarded as a member, I did highlight that in terms of executives, when we onboard executives, we do we do offer a VIP treatment to those executives where we go and sit down with them. Again, in this instance, we then received a request from a specific Mr. Anton Minar. Anton Minar is an employee of ESCOM. I believe that he is the general manager, HR remuneration at ESCOM. Our understanding as the fund is that he's the one who deals with remuneration, pension fund issues for executives at ESCOM. He then contacted the fund and contacted particularly Mr. Solin Nsibande from the fund. Mr. Nsibande is the client liaison manager of the fund, so he would be the one that would be expected to go and engage with executives at ESCOM and advise them about the pension fund and how the pension fund works. So this took place, and there was a meeting that was held. I think the first meeting was held on the 29th of September, 2015, where Mr. Nsibande went to meet with Mr. Molefe. In meeting with Mr. Molefe, Mr. Minar was present as well at that meeting. And the subject of discussion was that Mr. Molefe wanted to understand that he had benefits, pension benefits at Transnet that he wanted to bring over to the fund. So he wanted to understand how that would work and whether the fund could accommodate taking over those benefits that he had at ESCOM. There was a discussion around that. He was informed that in terms of the rules of the fund is actually able to take those benefits. We then categorize those benefits as additional voluntary benefits. They become additional. They do not form part of your basic pension that you would contribute to the fund. The rules allow for that, and excuse me, there's various other members in the fund that have brought in their benefits. Or what you can do as well is, I did allude earlier on to the fact that there's a calculation that is used where there is 7.3% plus 20.5%. if a member chooses to also contribute more, they can contribute. The rules allow for that. And again, that does not form part of your basic pension, but it goes into what we call an additional voluntary scheme. So he was advised that this could happen. Then he was advised that he would have to inform Transnet Pension Fund. Transnet would have to go through particular steps up to a point where they would have to apply for a tax directive, and then once that was approved, they would come to the fund with something that's called an ROT. An ROT is short for what we call a recognition of transfer, which then means that the fund can then accept those funds from Eskom. This benefit was in the region of about 4.2 million that he wanted to transfer from Eskom, from Transnet to Eskom. That process unfolded, and I think Transnet went through. I can't speak for Transnet, but we then eventually got the correct documentation, and the money was transferred over to the fund. Then there was various other meetings that were requested by Mr. Anton Minar. I would probably just try and go through some of the meetings and very high level highlight what would have been the discussion. So I think around about November, there was again another, some of these were emails. In our submissions, we have attached all of the correspondence. Some of these were meetings. So there was various correspondence where Mr. Minar, I think as early as November 2015, was requesting the fund to do calculations in respect of Molefe's overall pension payments and any early retirement costs in the event that Mr. Molefe were to retire 5 years later when he was age 54, and what would be the cost implications if the penalties were waived. We calculated those benefits. And at different days and different times, there were these requests that came through via email to say, now calculate what happens from the age of 55, what happens at the age of 63. And all of this took place around about November 2015, where we then calculated, did various calculations. And I think in one of the emails, that was sent to us, we were put under pressure as the fund to say, we need this information urgently, because it was saying that calculate these numbers as the information is required to finalize the issue with the minister. So we don't know what minister they were referring to, because it didn't say what minister, but it just said we need this information to finalize the issue with the minister. And again, as the fund, we provide a service to the employer. We did the various calculations and sent those calculations over to Eskom. Then Molefe became a member. There were no further interactions. He then contributed all the way until about August 2016. I think on the 18th of August 2016, we received again a request from Anton Minar at Eskom, now requiring the fund to do early calculation for early retirement costs if Molefe were to be retired at the age of 50, with penalties being waived and additional years of service being bought up to the age of 63. Again, the fund calculated those benefits and then gave the information back to Mr. Minar. I think he then, at the time, the cost of the benefit, I think we had calculated it in August to be around 25.9 million. That if he were to be retired at age 50 and they were to buy him additional service up to age 63, what would be the cost? It was around 25.9 million at the time, which is different from what actually the 30 million eventually that the cost of this benefit became at the end. The difference is really as a result of the fact that there are certain variables that at the time we did not have. For example, number one, this calculation is based on the cost. So at that time when we did the calculation, I think his salary had not been adjusted upwards. Also, when we do the assumption, we have to factor in the issue of a spouse. We make assumptions that the spouse will be about 5 years younger than the member. So if the spouse turns out to be much younger, that also affects the cost of the benefit. So when we did the initial cost at 25 million, those two issues in the main, we had made assumptions, used the existing salary, as well as a spouse who is 5 years younger. When the final calculation was actually done, we now had actual numbers where the salary had increased, as well as I think Mr. Molefe had married a spouse at that point in time who was much younger than the 5 years. So there was a much bigger gap between the 5 years we had used as an estimation, as well as the actual.
He was aware of the rules, so.
Madam Chair, I think, as I indicated earlier on that, it is our expectation that ESCOM knows the rules. ESCOM have applied these rules on numerous occasions. So we then, there was that exchange. We then gave the numbers to them. And then later on, I think this was now in sometime in November. Again, we kept on getting requests to do different calculations, and around about December, I think early December, we then received a request for a meeting again from ESCOM. And I think in this instance now, the meeting, I think it was about the 19th of December, the meeting was now requesting for the collection of documents at ESCOM. So again, Mr. Nsibande went to ESCOM and met with, I think, a Miss Merinda Porter, who works in Anton Minar's office, and collected documents. Now, these were the documents that were dealing now with the exit of Mr. Molefe. In the documents that were collected, there was firstly a letter. Okay, maybe let me start with the form. There was a form that had been completed by both Mr. Molefe as well as ESCOM itself. And in this form, they ticked the relevant boxes to say we are retired. Mr. Molefe is being retired using early retirement. Then that was accompanied by a letter. This letter was signed by the then Dr. Ben Gubane, who was the then chairperson at the time. And the letter was very clear that, Mr. Molefe, your application for early retirement has been approved, and we are invoking Rule 28 as well as Rule 21.4. So there was no ambiguity in terms of which rules ESCOM wanted the fund to apply. In terms of Rule 28 and Rule 21.4. And then it further stated that any penalties will be waived. It further stated that they would, purchase additional service for Mr. Molefe of 13 years, which then took him to age 63 because he was turning age 50 in December. So it was very clear from the fund that, ESCOM understands the rules. This is what they've given us. Ours is to test that, if they say Rule 28, is it 50 years? Are they going to pay additional cost? We have to recover those additional costs, and everything, according to the fund, had been ticked. So when the fund received this information, it went through the normal processes. I had explained earlier on that we've got, various delegations. Normal processing is something that myself, I would not generally have sight of, because there's processes that, had been agreed that this is how the delegation works. I'll deal with the issue of when I first became aware of the issue. I think the first time I became aware of it was around probably probably, I think it was about August or September when they were now saying we must calculate. This was in 2016. As part of normal discussions with my team, I think the issue did come up that Eskom had asked the fund to calculate these benefits for Mr. Molefe. There may be a possible exit of Mr. Molefe. And I noted the issue, the discussion was along the lines that it must just be done in terms of the rules. And then I never heard about the issue until much later. So when we got the claim forms were processed in the normal manner, where they went through the processing department. The processing department, as part of Rule 28, have to check the age 50. Yes, Mr. Molefe will be age 50 effective 1 January, which was the date that he was going to go on retirement. He was going on 31 December, but was going to become a member on 1 January 2017. He had met that. The employer had actually submitted a letter which then confirms that they had applied Rule 28. Again, we satisfied ourselves that Rule 28 is applicable. He did not have the 10-year required service, and this is where the employer invoked Rule 21.4, which Rule 21.4 enables the employer to actually buy additional service. He then also, the employer was very clear that the penalties must be waived, and they will foot the bill, take up the cost for those penalties. So it then got processed. It went through the normal delegations. It was signed off. We checked the calculations. We applied for a tax directive. Mr. Molefe opted to take 1/3 of his benefit in cash and left 2/3 to buy him a monthly pension that he would then earn until end of his life. And then the spouse will assume pension as well. That's why it's important for the fund to understand the age of the spouse, because if the member is no more, then the spouse, in terms of the rules, then assumes the pension. So that affects the cost if the spouse is much younger. So this was then processed accordingly. Come 1 January, Mr. Molefe became a pensioner of the fund. He was exited. I think in terms of paying his benefits, there was a bit of a delay because it was firstly the January season where things were closed. But then we applied for a tax directive. We received a tax directive. And if I'm correct, I believe around about February sometime is then we were able to pay him his pensions from 1 January 2017. And then at some point as well, around about February, we paid him